I think we've got a parallel and equivalent mechanisms to everything that's going on in the blockchain world, but we just don't have the compute time of having to hash everything and recalculate it at the point that each transaction's added. And so, much more sort of efficient and simpler to actually operate day to day. Other banks, insurers will be looking for those opportunities to aggregate your data so that they can then sell you marginal product and look, opportunity spot, look for those life events, kids going to college or, weddings or cars or other things that you might want to help save for or have finance to support. Those sorts of opportunities will be pattern spotted.
I think open finance is the way to go. It's great for customers. It's great for competition. There's been a lot of friction. Some of it is very understandable and legit. A lot of it, though, is inertia and banks and others just protecting their existing business. There are many models around the world, but I think the one that's now developing in the United Arab Emirates is worth everyone's attention. To explain it to me is Jonathan Holman, who's sort of the acting CEO of the newly incorporated firm Nebras. Jonathan Holman from Nebras, welcome to the program.
Hi, Jamie. Thanks for having me. Appreciate the time.
So I'm pleased to have Nebras on the show because I'm very interested in open banking and open finance. I feel that there's a lot of merit to these models, but around the world, there's different ways of approaching them. I feel like these approaches obviously everything has its pros and cons, but there's been a lot of flaws and a lot of resistance. And perhaps sometimes just a lack of use cases or at least imagination. So you are based in Abu Dhabi. You're CEO of a company that has been basically set up by the central bank of the UAE. Tell us about what is the vision in the Emirates when it comes to open finance, why they've set up Nebras.
Yeah, sure. So, my name is Jonathan Holman. I'm head of open finance for the UAE currently. We've only just incorporated Nebras on Friday last week, so we haven't actually sort of formally designated any roles inside the organization. And that's because we're ecosystem owned. So all of the insurers and the banks that have been designated to be part of the active scope for this first phase of open finance, they are our shareholders. And so it's taken a long time. We've got 86 potential entities in scope to become shareholders. On the incorporation day, around 40 of those were on the books as shareholders, and lots of the others intend to become shareholders. And that's really at the heart of what we're trying to do here, create an ecosystem entity that runs national infrastructure for a centralized open finance implementation. We set the standards, we run the infrastructure, and we act as this intermediation entity between all of the participants, known as LFIs, licensed financial institutions in the UAE, and TPPs, third-party providers, under the open finance regulation here. We are ourselves licensed by the central bank to operate that role, and now we're incorporated. We'll be finalizing that license with them. And it's a real privilege to have the sort of heart, the data, the standards, the infrastructure, the contact with the whole industry to really try and do something special here. And our ambition, simply put, is to build the world's leading open finance ecosystem here in the UAE.
Tell me about the strategic decision to do it out of the central bank. So we've seen in places like Australia, it comes out of the competition law. In Hong Kong, where I reside, it's basically banking regulation, and I think also it comes out of central banking regulation or competition in different jurisdictions, and that has a very different impact on how different participants see what open banking is. In some cases, it's just I've got to comply with my regulator, so I have to just tick that box, and often it becomes this sort of a compliance first process. In other cases, I think when you've got a competition authority, it's not specifically around finance, although it quickly ends up being about finance, but the drivers are different, and who can participate is different. You're doing something that's based out of a central bank initiative, but it's not really a compliance function. Rather, it's a whole different centralized setup. So walk us through a little bit about how this is different from other jurisdictions and what Abu Dhabi is really trying to achieve here.
Yeah, so I mean, this is a federal initiative across the whole of the UAE, obviously led out of Abu Dhabi, where the central bank and most of the government is in the country at a federal level. And yeah, the initiative is really to create a fintech ecosystem, and to do that, to create this new kind of consumption and interaction layer with financial institutions. And we really want to do that on the basis of a win for the financial institutions. So they've got a new channel, a new product that they can commercialize, they can monetize via APIs, that those APIs become a condition of a license here to operate as a bank, as an insurer, as an exchange house, as other types of financial services firm in future. You will need to have an API version of your distribution, but that we also create viable and scalable business models for the TPPs, and crucially, that there's actual wins for the customer in terms of customer experience, functionality, access, aggregation, particularly with the dawn of AI, the intelligence that one can have over interacting with financial services. And we feel that the fintechs can maybe be, slightly freer to innovate, to pioneer, to aggregate as a neutral party, and that we're trying to achieve a sort of digital leveling effect in that, for example, in open banking in Europe or in the UK, you had to have a digital channel, either an app or a web portal to your online banking to be in scope of the open banking initiatives there. And that's because they needed a vehicle for the consent journey to manifest in. Now, we offer the ability for LFIs to have consent journey and the consent management in their own app or web portal. And many of the larger institutions choose to do that. But for smaller insurers, maybe some of the foreign exchange firms, other entities that will come into scope in a broader open finance, running consent, having your own digital channel, just something that people do. And so we're able to leverage UAE's national digital infrastructure, things like Emirates ID, UAE Pass, that's the sort of digital authentication associated with that, and do consent as a service for these financial institutions, enabling their customers digitally. That means that they can then consume digital financial services through their chosen TPP. And that TPP could be provided by another bank, another insurer, or a third party kind of fintech that helps create the same digital capabilities across all of the ecosystem. And it stops the biggest institutions with the most money having the best apps. And instead, it sort of is an enabling and leveling feature across the country in all parts of the UAE. All different demographics that are being served by different banks, different institutions can all have the same features and benefits from a digital perspective.
What does that mean in the pros and cons of that? Because I think that the pros to me seem very obvious because in many jurisdictions, API connectivity and consent methodology, consent mandates, it's all bilateral. It's all a little bit arbitrary, and therefore it's quite expensive for the banks to manage because it's different with every different provider. So as in your case, you're just basically providing them one set of APIs, standardized, the same standards that everybody else uses. So from a costs perspective and a go-to market perspective, it seems a lot easier. The downside is when you get into open finance, then it's less about price or even product, and it's more about service. So how can players provide a differentiated service? How are they going to compete if the experience to the user feels similar everywhere they go?
Yeah, I mean, obviously, with a sort of digital leveling effect, you create this kind of minimum bar of what we expect or what we think customers should have access to in order to interact with financial services. And that is a sort of democratizing effect that no matter the insurer, no matter the bank, you're going to be able to sort of make payments in a certain way, you'll be able to access data, and crucially, in future, link that to intelligence, which will probably be a means by which people will consume and interact with financial services. What we never would have said back in the day, oh, everyone's got pen and paper, therefore that's a leveling effect. How does anyone compete? Oh, everyone's got checkbooks, everyone's got branches. How do they compete? Well, of course, the heart of financial services competition, yes, will factor in price, but will be about the features, the quality, the kind of the usefulness and the relevance of their product into their customers' lives. What we want is really competition to focus in that area, and that the kind of digital leveling effect is removing a barrier to access, and particularly across the different demographics that we have here. They interact with financial services quite differently. You've got people who've got bank accounts, people who've got e-wallet accounts, or people who've got prepaid sort of salary cards. And those are often in quite different ecosystems with access to quite distinct and different financial services and different institutions. And we're saying, your budget should be the varying factor, but your access to digital financial services shouldn't vary so much. And so TPPs that can aggregate across that entire breadth and depth of different types of LFIs with different financial services at the back, but that can provide a leveling interface, that helps financial inclusion, right? And that's a big thing that we're motivated by here. We want financial institutions to compete onto product and service outside of basic digital equity, but there are many, many areas where lots of institutions will compete to provide the best digital services well above and beyond. And as I say, we think that probably is going to manifest in the form of intelligence in the future. But if they haven't got the appetite to do that, or they're not willing to innovate, the third parties can come along and do that without disrupting who's providing the financial services. Crucially, TPPs, it's just a consumption and distribution layer that hopefully can be profitable with our commercial model. It can be not onerous because of our liability model. TPPs take responsibility for what they do. But it can create this new product, this new channel that banks can think of as a means to get a wider reach that they wouldn't probably otherwise be able to distribute to organically.
What's the difference between your founding members who are banks and insurance companies, and who are they sort of obliged to connect with via your centralized hub versus the TPPs, the third-party providers I assume that normally are the consumers of this data? Who are they, and how much of those relationships are, can be made exclusive or voluntary? Just paint me a picture for what's the breadth of the network, and how much of it is mandatory that they all connect to each other, or they pick and choose based on their commercials?
Yeah, so the main advantage of our central platform is that one connection to us on either side of the fence, LFI or TPP, means you can access everybody on the other side of the fence. And so for LFIs, we're able to provide some infrastructure as a service. We run consent centrally. We run some of the more advanced payment features and other things centrally. And each LFI has its own instance of our API hub that federates, sort of aggregates into the sum of the parts, the whole of the platform. TPPs with one connection to that can then access and route to any particular financial institution on a standardized API basis. The LFIs, if you meet the kind of critical mass of market share, balance sheet scale, profitability, turnover, if you meet our sort of criteria at the central bank to be part of the active scope, then you're obliged to build those APIs and connect using the API hub. You can also choose, there is flexibility to do bilateral integrations with a large TPP if you wanted to in future, but obviously you're mandated to connect via the centralized API hub. And then TPPs is a voluntary scheme with its own license under the Open Finance Regulation that can then have access to all of the underlying LFI APIs. But we have, interestingly, had banks outside of that mandatory scope volunteer to be party to the ecosystem, particularly foreign banks that have seen it to be an important part of sort of national initiative with some innovative features. And also in foreign exchange, although we might eventually bring those into a mandatory scope, they're not now. And we've had 3 of the largest and 3 mid-tier firms in the FX space volunteer to become LFIs, and we've developed standards for them that they were able to contribute money to support the development of. So that, I think, is testament to the fact that people don't see this as a threat. They see it as an opportunity. The commercial model helps them monetize the products and services, the APIs they're going to develop, and that they've even volunteered to be part of it.
Right. In the UAE, you have a multiplicity of regulatory zones, free trade zones, and so on. So you're under the central bank, but does this apply to companies that are operating in or licensed by, say, ADGM in Abu Dhabi, or the DIFC in Dubai, or blockchain-based businesses in Vara? How do they interact with you, and what's your scope of reach with these places?
Yeah, so federal reach of the central bank is across the whole country, including the free zones, and so would cover those areas. Prior to a sort of holistic open finance regulation existing in the central bank, for all of the activities that the central bank's concerned with, FX, lending, banking, insurance, payments, and so on, there was alternative licenses from the DIFC and ADGM, which allowed for reverse engineering of APIs and for screen scraping, albeit that was on the back of onshore entities regulated by the central bank most often. And so there was a bit of a sort of a conflict there. The open finance regulation issued by the CBUAE is countrywide and prohibits those screen scraping and reverse engineering API activities, and concentrates the activity via the mandated specification standards, the new license for TPPs, and so on. So this applies across the whole country. You can, of course, apply for that license while existing as a corporate entity, registered in one of those free zones across the country. There are very many of them. Obviously, the two you named are the biggest ones. And there are even banks that operate within those free zones as well. So it will operate as sort of as one. What we're now looking at is other federal regulators, other government departments, other financial services regulators to look at the expansion and the sort of mirroring of our CBUAE regulation to then extend the reach into other areas of financial services adjacent things in the kind of audit, accounting, invoicing space that have great synergies with financial services, banking APIs, and then into the wider ecosystem, open health, open education, open transport. These are all interesting areas of the economy which can benefit from the same sort of principles.
What you were previously in your career, you headed up digital banking at Santander in the UK, if I remember correctly. Talk to me a little bit about use cases, since you were just touching on that and the expansion of the capabilities. What were you able to do when you were at Santander? What did open banking mean in that time, in that place? And contrast that to what you think it can mean now in the UAE as Nebras rolls out.
Yeah, so my role was head of digital for SME and corporate banking in the UK. So we were looking at mainly onboarding, lending, kind of monitoring use cases for open banking. But the idea was that you could permission someone's accounting data as well as their open banking data at some point during the onboarding journey, get a sense of their existing trading and previous performance, cross-reference those two to get a real-time sense of a sort of audited set of accounts of bank transactions that backed up what you'd see in management accounts beyond the kind of previous year's annual audited accounts. You could then use that for real-time credit decisioning. You could then use that on an ongoing basis for real-time monitoring. Even if you didn't hold the collections account or the current account, you could still have access to that data. And so that made covenant monitoring, collections monitoring, all sorts of activities could be automated, as well as decisioning up front. And then for the customers themselves, particularly in the sort of SME space, we pioneered long before Monzo were looking at this feature and have subsequently sort of rolled it out in their business banking SME app. A smart invoice where SMEs and small businesses are issuing invoices with open banking payments embedded in them that you can then collect into a central pot. You can then look at revenue-based sort of financing, sort of merchant acquiring financing equivalent. Those sorts of products that help working capital of small businesses as they're growing can directly correspond, translate, even intercept that income as it's being collected by open banking payments. Those become really useful features. So that was the sort of direction we were headed. By the time I left, we got to the sort of data and integration monitoring point, and we were about to move on to that next stage. But had designed the smart invoice proposition, and to say both Xero on their platform with app plugins, as well as a bunch of other banks have launched that subsequently.
And what's the vision now? Where do you think this can go?
So in the UAE, the ambition is well beyond where the kind of scope and possibilities lay in the UK. So, open banking has got data sharing and payments APIs as our first form of service initiation APIs here. Open insurance has got data sharing APIs about existing products, and then quotes APIs that are tailored to you, to your insurance policy, to your risk profile across 6 major insurance products in the UAE. And then FX in the voluntary scheme has actually got the 4 lifecycle API groups that we envisage. They've got a version of all of them. So that's quotes of a particular FX transaction, then onboarding APIs. So you can actually onboard to the new LFI that you like the look of the quote from via the TPP. Then service initiation APIs to initiate an FX transaction or an international payment, and then data sharing to look at transactions you've previously undertaken with that institution. And that whole life cycle of a customer and the depth and breadth of those APIs within those 4 categories is where we see expansion in banking, in insurance, and then into other sectors. I think investments and wealth, there's a lot of scope for aggregation and data sharing. And then I think there's this sort of holistical personal or business financial management proposition, cash flow analysis, income expenditure analysis, done on a much more sophisticated level with AI embedded into those sort of TPP solutions. Other banks, insurers will be looking for those opportunities to aggregate your data so that they can then sell you marginal product and look, opportunity spot, look for those life events, kids going to college or, weddings or cars or other things that you might want to help save for or have finance to support. Those sorts of opportunities will be pattern spotted in a sophisticated way with AI, whilst providing value-add services to customers. And we've thought about a whole world of sort of embedded finance propositions here that have real value to the customer. So you're scanning a car's license plate, it's pulling the details of the car from central government police records here, cross-referencing that with real-time quotes for you for that car, for insurance policy for the coming year, for finance quotes for that car. The same thing, you're going to visit a flat or a house and you could scan the flat from the outside on the street and then get real-time senses of what a sort of staggered rent payment finance package could look like, or what the mortgage and insurance payments could look like. That sort of augmented reality, slick embedded finance that's in these other ecosystems, car, health, travel, home ecosystem. We think those are going to be really powerful. And those 4 life cycle groups of APIs will make that integration, that synergy possible.
Since Nebras was first discussed, I think it's been about a 2-year process. We've seen leaps and bounds in AI, and there's a lot of talk now about agentic.
Right.
So walk me through, this has been happening in parallel to your own, establishing the licensing in the corporate entity. What is the idea how you see agentic could play a role in this? Is it a little too early yet? Is there enough confidence in the idea of sort of handing the keys to the computer to transact or to make choices? How do you think about that? What are some of the risk management facets that you are thinking about?
Yeah, so I mean, we're lucky as the kind of national operator of the infrastructure setting the standards that we are really in the kind of execution arm, and the regulation and the control of that risk happens at the central bank. And so we just provide the tools, and it will be on them to decide what they're going to allow TPPs and LFIs to do. They're actively working on a sort of AI policy and more sophistication and help for the industry in supporting, exploring these propositions. But we've looked at MCPs as a way of interacting with the APIs for the main agentic and LLM models. We've held a hackathon last year with the support of ADCP, a bank here, which was really good, exploring these sorts of use cases using our sandbox APIs, using MCPs connected to them to help agentic access and interpret and utilize the APIs. We've built a bunch of demos of what's possible in data and analysis in payments there, including payment redirect journeys, which still have a pop-up notification on your bank app to confirm a payment that the AI is suggesting to make. So still having human control where you want it. I think there's almost infinite possibility in that space, and I think it will be the way which we consume lots of services and make lots of decisions will be through an agentic interface. I think the question is how independent is that? Whether you trust it more if it's embedded in a financial institution, how they manage the sort of self-recommendation and bias of that. If you're trying to have these kind of whole of market quotes like we enable with these mandated APIs, I think there's lots of detail and nuance to work through there. We will create the pipes and there are some issues around liability and sort of security with MCPs, but the technology will mature. I think we'll get to a place where we can secure those pipes, and then it will be an opportunity for the regulator to come in and say what they want to facilitate. But the UAE will always be ambitious and making big investments into AI, and will want to help companies explore that possibility here.
You mentioned liability. As you're exploring agentic use cases, what does liability mean? In open banking in general, in other markets at least, banks have been wary of it. One reason for reluctance has been that in most cases they are liable if there's a breach, or at least reputationally, if not legally. When it comes to agentic, this is new territory for everybody. So just how are you kind of thinking about that, and your IT teams, your technical specialists, what are some of the issues that they're starting to raise?
Yeah, I mean, there's lots of detailed and nuanced implications of AI, a bit like self-driving cars, right? Who's responsible if it's just a machine doing it? So there are lots of things to work through. what we're keen on is principle-based regulation and then a sort of principle-based liability model. And that means that whatever you do in our ecosystem, as a TPP, as an LFI, even us as the national infrastructure operator, we are responsible for our own part. And we know in other jurisdictions they've made arbitrarily the LFI, the bank, 100% responsible even for what the TPP does. That obviously makes them terribly conservative. They've made either party 50-50 responsible, even though the error could occur on either party. You're still liable for it. And they've made TPPs sometimes more responsible in other markets. We've decided to look, whatever you're doing, whichever task you're undertaking, whichever part of the journey you take responsibility for, and that can vary in different APIs with different choices of functionality, but you have to take responsibility for it. I don't think that principle will vary dramatically with AI, that both, the independence of a decision, what was empowered. We have guardrails, of course, in the consents that the consumer can set and can allow, or the business can set and can allow control and throttling of use and the amount of money to be moved and so on. But agentic can, do all sorts of things, including hallucinate, which will create problems. And I'd say that will be for the regulator to decide how they manage that and what they license and for what purpose. But we will try and make sure that that things are at least secure and functional, and that the systematic constraints are there and watertight, so that the APIs can only do what they're intended to do and nothing else.
How do you address the other risk of building a centralized API hub, which is that you become the single point of failure?
Yeah, so obviously a big consideration when we looked at this model, and we're the first kind of mandated jurisdiction to do this in this way, although lots of people are now looking to follow us. The main mitigant I cited earlier is that each LFI has its own instance of our API hub. And so essentially we're not a single point of failure. Everyone's got their own instance of that bit of software. We're cloud hosted in multiple availability zones, multiple regions have been possible as well. And so between the trust framework and the API hub, we can spin things up in other clouds. We can switch over to different availability zones and regions. And then each LFI can only sort of affect and damage itself. That makes it difficult when we're upgrading versions. You have to deploy to every single instance, to every single LFI in sandbox, pre-production, production environments. We have to coordinate and manage that process across the whole ecosystem, and particularly as it expands, that gets ever more complicated. But the increased time to market, or decreased, I should say, time to market, the increased power, visibility, transparency that gives us, and the ability to sort of keep everybody roughly moving as a pack towards a critical mass of functionality and development, new versions of the standards is really priceless. And it has lowered the implementation cost and raised the sophistication of what's been possible to implement because of the infrastructure choice. So we're really pleased with the way that's gone, and we would advocate it to other countries considering doing open banking or open finance.
There are parallel movements in the blockchain world. So I'm thinking, for example, zero-knowledge proofs, which can take essentially a user-consented scraping and turn that into credentialing, or tokenization and leveraging some sort of public chain, perhaps, to create a distribution model. How are these different ideas, to what extent are they compatible or relevant or not relevant to what you're building using APIs?
Yeah, well, obviously we hinge on a consent model that allows, public and private keys, people to do certain things, right? Certain institutions have certain roles on the trust framework, public and private keys to access it, and then certain consents allow an individual user via a TPP to do certain things with the LFI. All of that, is constrained by those two accesses. Essentially, the kind of concept of tokenization is embedded in those consents, right? It sort of gives you the access and allows you to do or not do with a certain expiry. Those consents are quite sophisticated when it comes to payments and other things. They set a lot of parameters. There's lots of controls and lots of variants of them. I think with other use cases, as they continue to evolve, new types of service initiation beyond payments, I think we'll have maybe increasingly more complex consents, loan drawdown and the consent for that, for example. Where that money goes, a crucial step in that lending journey, that would have to be very sort of tightly constrained. I think we've got a parallel and equivalent mechanisms to everything that's going on in the blockchain world, but we just don't have the compute time of having to hash everything and recalculate it at the point that each transaction's added. And so, much more sort of efficient and simpler to actually operate day to day.
Last question for you, Jonathan. And again, thank you so much for joining me today. What is the prospect for going cross-border with your open finance initiatives? I mean, you mentioned that other governments are looking at what you're doing, um, but is there a role at some point where embedded finance can become a cross-border phenomenon?
Right, absolutely. So I worked to initiate a project with the BIS Innovation Hub in Hong Kong called Aperta, which people can read about online. And the end of the first phase report will be published shortly. That was involving the UK, Hong Kong, Brazil, and the UAE, with a bunch of other countries, Singapore, India, the EU, Australia, and others as observers, to experiment in two things: looking at the potential to standardize APIs internationally so that they can become interoperable, but in the meantime, building a translation engine between the different standards of APIs in different countries, and then using a federated trust framework that could connect different countries together and use local access, local credentials in a global sort of network of networks that could allow people to send data and initiate services cross-border. And obviously that begins to speak to cross-border type use cases. So we experimented with trade finance and brought in ISO and other recognized standards for the instruments and the documents in that trade finance space, and then started using APIs to orchestrate those and coordinate between different banks and different jurisdictions. I think there's an absolute world of potential there. I equate it to the kind of impetus that got USB off the ground. You know, the story of USB-A, right, where it sort of 4 or 5 companies agreed to do it, but then it sat there, no one really used it until the iMac put it as mandatory on every port, on every part of the device, and then that, you know, took off. Obviously, USB-C coordination and sort of standard iteration. We went through DVI and HDCP and HDMI and all those other things before we got to USB-C that could embed and incorporate all of those features, as well as power, as well as data, as well as audio. So, you know, I think there's some obvious parallels to there. If the electronics industry can coordinate and do it, I think we financial services can do it the same. It's not in the inclination of financial services provider to create this sort of interconnected, interoperable network, because they see value in their own network and their own closed doors and their own inertia and their own sort of customer onboarding, and those are high barriers to moving. And that has been the nature of the beast. But I think the way globalization works, the way people's lives, business, trade expands across borders, I think these things begin to become difficult to enforce, and the advantage, the providers that afford the opportunity to interconnect, to interoperate, and then do that on a common standard so they can do it quicker, faster, more mature, more reach, I think will be a differentiating factor for those institutions. And, you know, we see with the likes of, you know, DBS in Singapore and other, you know, digitally enabled banks, they just build these APIs, whether they're asked to or not, in every market, right, that they operate, and offer connectivity. So I think that will become a mainstay of digital banking. It will become a mainstay of global banking, and businesses and people that are moving around the world will want banks that have these APIs to, you know, interact with them via their kind of aggregation platform of choice. And that, you know, if they're not in every country, that's okay. But, you know, they might want different accounts and different services in those countries, and they should be able to be connected together. So for trade finance and for international payments and for people like me who've moved around where they're working and living in the world, I think these services will become essential. And I think it's inevitable that we move towards a global standard, because for other countries that want to do this, right, building this stuff from scratch, the infrastructure, the technology, it's expensive and slow. And if you could take a model out of the box and take the technology out of the box and just copy it, the marginal cost for each country goes down and down and down. And I think that's only a good thing because of the financial inclusion and the efficiencies and the digitalization leveling and you know, other benefits that it can bring.
Right. Okay. Very good. Of course, then you're going to get into geopolitics, but we'll save that for another discussion. Jonathan Holman, thank you so much for joining me.
Thank you. Appreciate it. Thank you.